Every monetary system eventually faces the same reality. Societies change, crises emerge, debt builds up, and economic pressure accumulates. That pressure cannot simply disappear. It has to be absorbed somewhere. In the previous episode, we examined systems designed to protect the stability of money itself. When money is rigid, adjustment is pushed outward into society, into employment, income, and defaults. But there is another design. What happens when the money system itself is built to absorb the pressure instead? When flexibility replaces rigidity, does the strain disappear, or does it simply move? If money is going to absorb pressure, it cannot be tied to something fixed like gold. Under the gold standard, expansion was constrained by a physical anchor. Governments and banks ultimately had to defend convertibility, which limited how far the system could expand. Fiat money removes that anchor. Modern currencies are not redeemable for metal and are not limited by physical reserves. Instead, most money today is created through the banking system itself. When a commercial bank issues a loan, it credits the borrower's account with a deposit. In that sense, money is loaned into existence. As loans are repaid, those deposits shrink again. Central banks influence this process by setting interest rates, adjusting reserve conditions, and buying or selling financial assets, which affects how much lending can occur across the system. Because of this structure, the money supply becomes elastic. It can expand when credit expands and contract when credit contracts. This flexibility allows the system to respond to growth, crisis, and structural change in ways a gold-anchored system could not. But if money can expand when pressure builds, what happens when the system actually needs that flexibility? That flexibility exists precisely for moments of stress. Financial systems are built on promises. Banks promise depositors access to funds. Borrowers promise repayment, and markets assume credit will keep flowing. As long as confidence holds, the system functions. But when confidence breaks, during banking crises, market crashes, wars, or deep recessions, those promises begin to strain. Under a rigid system, adjustment happens directly in the economy. Banks fail, credit collapses, businesses close, and unemployment rises. Fiat systems were designed to respond differently. When banks face liquidity shortages, central banks can lend reserves. When financial markets freeze, authorities can inject liquidity. When borrowing slows, interest rates can be lowered to stimulate credit again. Instead of forcing the entire shock into wages, employment, and defaults, part of the adjustment can be absorbed inside the money system itself. Liquidity expands, balance sheets grow, and time is bought. This flexibility can prevent immediate collapse. But if the system absorbs the shock through money itself, where does the cost eventually appear? When the money system absorbs pressure, the strain does not vanish, it moves. Expansion of liquidity and credit can gradually change prices, asset values, and purchasing power. Unlike sudden unemployment or mass defaults, these adjustments often unfold slowly. Asset markets may rise first. Borrowing may become easier. Financial conditions may appear stable. Over time, however, the effects spread more broadly. The purchasing power of savings may erode, wages may struggle to keep pace with rising costs, and asset owners may benefit disproportionately from expanding liquidity. Under fiat systems, adjustment tends to be diffused across society rather than concentrated in immediate collapse. The system avoids sudden breakdown, but the cost becomes broader, slower, and often less visible. So if flexibility protects the system in the short term, who ultimately controls how far that flexibility is used? Because fiat money is not anchored to metal, its expansion depends on institutions. Central banks influence liquidity, governments influence debt issuance, and financial markets influence how easily that debt can be financed. In normal times, this system operates quietly. During crises, however, these roles become highly visible. Central banks lower interest rates, lend to banks, purchase financial assets, and expand reserves. Governments run deficits to stabilize the economy, issuing debt that is typically rolled forward rather than extinguished. This does not mean the system is uncontrolled, but it does mean expansion ultimately becomes a matter of policy choice. Every intervention that absorbs pressure today can postpone adjustment into the future. Debt can be rolled forward, liquidity expanded, and markets stabilized. But postponed adjustment does not disappear, it accumulates. Before we continue, if you think this is valuable, please like. It helps share it with others. Subscribe so we stay informed together. Over time, stability depends less on physical limits and more on continued institutional credibility. Trust becomes the final anchor. As long as that credibility holds, flexibility can stabilize the system. But if accumulated pressures grow faster than confidence, institutions may eventually discover they can no longer manage the strain as easily as before. Because every monetary system ultimately faces the same structural constraint. Shock and discipline cannot occupy the same place. When crises or structural pressure emerge, the adjustment must be absorbed somewhere. If the monetary system is rigid, discipline is enforced inside the currency and the shock is pushed into society through unemployment, defaults, and contraction. If the monetary system is flexible, the shock is absorbed inside the money through expansion, inflation, and institutional intervention, and discipline must instead be maintained inside the institutions managing the system. No system can avoid this trade-off. Because fiat systems can repeatedly stabilize crises, they can also allow financial imbalances to build for longer periods. Debt can grow larger, balance sheets can expand further, and institutions can become more interconnected. Flexibility can prevent immediate collapse, but it can also postpone adjustment. When correction eventually comes, it may involve higher debt levels, broader institutional exposure, and a larger share of the economy than would have existed under more rigid monetary constraints. Every money system must ultimately decide where shocks will be absorbed and where discipline will be enforced. Hard money systems protect the stability of the currency and force adjustment into the economy. Fiat systems protect the stability of the economy and allow adjustment to appear inside the currency and the institutions managing it. Neither system removes constraints. They simply relocate them. One concentrates adjustment sharply and visibly, the other spreads it gradually and often invisibly. One relies on external scarcity, the other relies on institutional credibility. Understanding this structural trade-off is essential because debates about gold, inflation, central banks, or monetary policy are rarely really about ideology. They are about where a society chooses to absorb pressure and who ultimately bears the cost. And that question does not end with fiat money, because once flexibility exists, the next question is not just how money adapts, but how long that adaptation can continue before the system itself begins to change. Hard money is part of TNBC Explainers Module 3, Economy, Money, and Financial Power. Explore the TNBC Explainers course via the YouTube course list or visit thenextbigcycle.world for the full course overview and background. This is The Next Big Cycle, TNBC Explainers, your guide to understanding the systems shaping the world around you. TNBC Explainers is a growing YouTube course. New concepts are added over time.